Okay, so you read quite a bit about student loan interest in your chapter, and there's a lot of qualifications for it. Specifically, we just need to make sure whatever we take out in loans is used towards qualified education expenses. And the big thing here is that we are allowed to use loans towards room and board. That's really big because we'll learn in future chapters about other education deductions. We'll learn that room and board is not included, but for this, it is. So everything related to education, like tuition, required books and fees, supplies, equipment. You could even get a laptop with your loans. Your transportation, if you buy a bus pass, and there's some gray area there with paying for your own vehicle, but things required for education, okay, for higher education. And it does have to be at a qualified institution as well. So we're talking about colleges and universities, not necessarily our skilled trades, things like that wouldn't always work. So it just depends. But okay, let's read our example here. Tam attended Brown University during these years. She lived at home and was claimed as a dependent during her education. However, we're going to read in just a minute. She is now on her own and paying her loans. Okay, so the fact that she was claimed as a dependent during her education does not affect her ability to claim the student loan interest deduction, because at this point we're beyond those years and she's paying the interest on those loans. So now that she's not being claimed, and we read that later, she is not, or she is allowed to claim this. So she's not limited for that. All right. Anyway, so she incurred $10,000 of expenses. All right, let's start to write some things down. So we're reading this real quick, and let's just highlight. She incurred $10,000 of education expenses, and we are going to go ahead and assume that those educational expenses are qualified. So they meet those tests that we just talked about. Doesn't include things like meals or clothing or anything like that. No, it's truly education expenses. Okay. And we are also assuming that Brown University is also a qualified university, right? So most of the time you read university, you'll be fine. All right. So now $10,000 of expenses. Okay. $10,000 of qualified education expenses. Let's write that down. $10,000. I'm going to keep using that word, qualified education expenses. All right. Now here's the problem. She has $2,000 that was paid for by scholarships. So we need to subtract $2,000 from this because she didn't pay for it. It was paid for by scholarships. So she only had to cover $8,000. That's all she had to pay by taxpayer. So we're going to learn in a minute she paid for it. The loans are in her name for these qualified education expenses. Okay. Now, let's keep reading. To finance her education, she borrowed loans. Now, how much did she borrow in loans? Let's highlight this. She borrowed $6,000 to start through a federal loan program, and she borrowed another $4,000 from the bank. So in total, she borrowed $6,000 federal loan, and she borrowed $4,000 from just a private bank. I'm just going to put bank. Could be a credit union, whatever it is, doesn't matter. Those two can be added together. So she has $10,000 in total loans. Okay, there's our problem right there. She has $10,000 in loans, but only $8,000 in expenses. So this $10,000 is now going to be limited. It's going to be limited to $8,000 because her total loans cannot exceed the amount of her qualified education expenses. So whether our limit is because of the scholarship, or maybe our limit is because it wasn't truly qualified education expenses, maybe she included meals, money for her, maybe she lived in a dorm and the meals were included in her room and board total bill. So it was included, we would have to subtract that out. We can't pay for that. We can't. Same thing, scholarships. It has to be taken out because it's not part of what she paid for those qualified education expenses. So however it's limited, it could be limited, right? So in this case, limited because of the scholarships. So instead of $10,000 of total loans, she's only going to be allowed to deduct the interest related to $8,000 of those loans. All right, so let's read about the interest. So here's what we have for interest. And here's where it says after graduation, she married and moved with her spouse to a distant city. So that's where I went ahead and assumed she is not being claimed by her parents. She's married, she's moved away. There's no way her parents are claiming her. Most likely, I should say, but we can assume that for that information. Okay, so during the current year, she incurred $600 of interest. Let's highlight those. $600 of interest on the federal loan, $400 on the regular private loan. So in total, $1,000 of interest, right? So you see that $1,000 of interest there, 6 and 4. I've got $1,000 of interest. Okay, so am I going to be able to claim all of that interest? No. The reason why is because we're limited. We took out a $10,000 loan and it was limited to only $8,000 being allowed here. So let's calculate if we take that $8,000 total allowed, divide it by the $10,000 in total that I have, total loans, I'll figure out that 80% is what I'm allowed to deduct. Now this one's pretty easy. It looks like $1,000 of interest in total. It's going to be $800 that I'm going to be allowed to deduct, right? And that's exactly what we do is we take the allowed percentage, multiply it by the total interest, and we find that she can deduct $800 as an adjustment. This is a student loan interest adjustment. So we say deduct because it's subtracted, but it is an adjustment on the tax return, right? It goes on that Schedule 1, it gets subtracted, and helps reduce our amount of taxes that we're going to pay. So this is always something we want to do. We want to be able to deduct this. It's just a matter of what are our limitations, right? The loan needs to be in our name, that the person who's deducting it, it needs to be in their name. Now they can be the main name on the loan, or they could be a cosign. So often students don't have enough credit, so parents are cosigners on it. However it works, either one of them at that time could claim it if both their names are on it. Again, limited based on actually being paid to the educational institution. In our case, it was limited because of the scholarship. It has to be claimed by someone who's not being claimed as a dependent by someone else. And then the last thing that this problem didn't have is that potentially we could have a limitation based on our AGI threshold. So in this case, I'll show you, we didn't have a limitation. They just told us in the problem. They said that our AGI was less than the MAGI, M-A-G-I, that's modified adjusted gross income. It was less than the amount. So if they had given us an amount that was greater than, we would have a phase out. So I have another video on that. All right, that's it for this one.